You can start.
All right. Good morning, everyone. Welcome to this episode of HyperInsights. And this is our second season called The New Normal. HyperInsights, as some of you know, was created as a forum for the fintech industry to engage in one place and to exchange information amongst each other. Especially relevant is today's episode where we have Anindya Karmakar from Aditya Birla Finance. We also have Kedar, who is the CEO of HyperVerge Inc. Hi, Anindya. Hi, Kedar.
Hi, good morning.
Good morning. Very happy to have you here, Aditya. I'm sure our audience is looking forward to asking you a lot of questions, especially considering you have a 2-decade-long experience in the not just the fintech, but also the traditional NBFC sector in India. So looking forward to having you here today and answering questions based on what the audience chooses in the poll. So quick message to the audience who's joining us right now. The usual format is we try to keep it as democratic as possible. So we've put up a poll right now where you can go through whatever questions we've listed down and you can vote for what question you want answered and we will prioritize that question. Meanwhile, while the audience takes this poll, I will let Anindya introduce Aditya Birla Finance Limited to us. I have the PPT open with me. Aditya, over to you. Anindya, over to you. Sorry.
Yeah, so can you switch the slide? Thank you. Thank you. Yeah, so the next slide, please. Okay, so Aditya Birla Finance Limited is a subsidiary of Aditya Birla Capital. Aditya Birla Capital being the holding company. There are several companies under ABC, in the industry, insurance industry, investment, etc. And this is the NBFC. It's one of the leading NBFCs in the country, one among the top 5 in the country based on the AUM. And it kind of straddles the entire spectrum, starting with the high ticket size corporate loans to mid-market loans, the SMEs, and then over the last 3 odd years has forayed into retail lending and the consumer loans as we call it. So that's a very short introduction about ABFL. I'll hand this over back to Deepak.
Sure. Deepak, if I may introduce Anindya sir, because I was gathering from Anusha all the interesting things that we have learned about him through our interactions. So Anindya sir is from IIT Madras, so it's a very warm day for us that one of our seniors is with us on the call. After IIT Madras, sir went into, and he has told us specifically that we should call him Anindya. So I'll continue with that. I think an MBA and then 3 big stints in 3 iconic organizations. Starting with Citibank, which at that time was the innovator coming from outside, bringing so much interesting technology into our country. Then ICICI, where of the many digitization initiatives, one was around how to make banks digital. And then we have a very interesting jump into Aditya Birla Capital, which is actually completely branchless, right? There is not, the model is completely branchless. So I think a career spanning, unique experiences in the financial services industries across these 3 organizations. And, obviously we are looking for a lot of insights. Apart from this, I think he has been an avid learner. So if you go through his LinkedIn, you can see that constantly there is a learning cycle, even formal learning cycle that is going on. So we'll be asking some questions on this as well. Yeah. Welcome, Anindya.
Thank you, Kedar. Pleasure to be here.
So to the audience, I want to say that usually you've seen that we have a very fintech and startup heavy panel. This time we felt that it would be extremely valuable for our audience to get insights from someone who has seen this journey of fintech evolving in the country. So in that case, in that regard, happy to have you, Anindya, and looking forward to those insights. Kedar, I would request you to quickly introduce HyperVerge for those who are new to the forum.
Sure. Deepak, if you can just help me with the presentation as well.
Yes.
Yes. So HyperVerge is an AI company. We started in 2014. Before this, we were a research group of students at IIT Madras. Used to do a lot of work with the professors there. We used to work with industries such as ITC, MRF, used to represent India in robotics. And all of that led to finally starting HyperVerge on, a few nights conversation with friends. And we got funded in 2014. So we set up office in the Bay Area. We set an office in Bangalore in India, where largely we operate out of today. The one thing that HyperVerge is known for is our financial services business. We also have a geospatial business. Our financial services business largely focuses on KYC, fraud checks, as many ways as we can help the lenders or the credit card issuers or the telcos make their decisions faster, serve the customer faster in a digital manner. Our geospatial business looks at large amount of satellite images, and we find out insights within these satellite images of what's changing, what is critical infrastructure, where are people developing interesting things, and work largely with defense and governments to help their efforts. The marquee clients HyperVerge works with are listed. And the most important, I think, joy of doing this is it's a completely new area for us. All of us, we are a very young team, average age being 25. So being able to learn from all of these amazing organizations and create products that help them learn from each other, create products that, help all of them move forward, has been an absolutely delightful journey. Usually they say, which segment do you choose when you start a business, right? And we are very, very happy that we chose financial services, where any new innovation or any technology is taken up and tested and experimented so quick. So that's a quick intro of HyperVerge.
Thanks, Kedar. We will quickly now look at the poll questions to see which questions our audience wants answered the most. And I think by far, there seems to be a lot of interest in what will be the next normal for BFSI. So Anindya, I think you're the best person to answer this question, having led transformation journeys at ICICI and later now at Aditya Birla as well. When we talk about digitalization and we talk about digitalization V2, from your vantage point, what does the next wave of digitalization look like for the financial services industry?
Yeah, so it's quite interesting, and there is a risk in predicting the future as well, right? So, but you can look at the current trends, and you can kind of make very intelligent guesses in terms of what this is going to look like. Interestingly, I wrote a chapter in a book called The AI Book, which was published by Wiley in the month of May, which was a chapter dedicated to the future of deposits and lending. So clearly, if you talk about BFSI in general, my experience has been on the liability side as well as the asset side. And if I talk about the liability side, it's really, a bank account is nothing but a storehouse of money, right? Because you need to keep your money safe somewhere, and a bank account, earns you interest and keeps it safe. These are the primary, basically, purposes of a bank account. But that's not the only thing, right? And people obviously want to use that money in transactions. So that's really what it is. But if you see, keeping money, storing money safely, and then helping in transactions is not being done by bank accounts alone. And if you look at the whole wallet revolution which has taken place in India, and not only in India, in fact, in all the developed markets, if you think about Starbucks, for example, in India also, how often, you have seen people actually paying using the Starbucks app itself and not really using the bank account or the credit card. And Starbucks, has the number of accounts that Starbucks has is probably bigger than any largest bank in the US, okay? And the amount of money which is actually lying in the Starbucks wallet is much higher than probably many of the well-established banks that you will find. And Starbucks is not a bank really, right? So the whole power is actually shifting towards companies and service providers who are actually face-to-face with the customer. And the same thing is happening in lending as well. And so that's really what's going to take place. And the underlying ecosystem, which basically powers the transaction, is kind of getting very well defined with the emergence of nice, good, helpful regulations as well, and of course the technology and the new operating models which are coming up very quickly. So if you kind of look at the whole blockchain technology as well, which is nothing but a distributed ledger, and we don't have to go into the details of what a blockchain is, but if you kind of connect some of these technologies, which is blockchain, AI, cloud, and the whole storehouse of the money which people are keeping in various other places, you can actually look at the future 10 years, 15 years down the line, and then you will find that it need not be a bank where you actually keep your money. Okay, it could basically your refrigerator could be a storehouse of your money, and a refrigerator could be actually ordering 10 years down the line on your behalf, because it has enough data to realize what it should be ordering, what you like, and things like that. And the payment also need not be triggered by you, because you would have probably given a consent in some form to your refrigerator that when this thing happens, you can order from that place so much of quantity, and the money actually gets transferred into that person's that particular from where you are buying, the money gets transferred automatically. And multiple people can have you think about the ride sharing, for example, right? So everywhere, if you look at the money, it's basically grease. Okay, so there is an industry, and there are multiple industries, but money basically is the grease of any business. And you would have read about so many things in the future where you have the automatic cars which are going on, and people are using. You don't have to own a car, and everybody basically a segment, a lot of people basically own the same car, and everyone's wallet and consent and everything is kind of inbuilt using a blockchain architecture. So these are some of the things which will probably happen in deposits, right? And if you talk about lending, I think the interesting part about lending is that technology enables it enables the expansion of the market. Okay, so very few people today are actually on the bureau and are able to actually get money when they need it. And it's not only about the individuals; it's also about the small businesses, or the micro businesses. And what data is doing is that it is clearly enabling a lot of operating models to be built, and a lot of fintechs, of course, are at the forefront of this revolution. And it's basically helping in understanding the credit behavior. So a poor person does not mean he's poor in credit. Okay, and that's the real thing here. And microfinance revolution in India, therefore, if you see, has been so successful, right? And you would find that these are the people who are the most vulnerable when anything happens in the economy, or even a calamity like a natural calamity happens. Think about the Orissa floods, think about the Kerala floods, think about the tsunami, right? These are the people who actually get affected. But over a period of time, they pay back. Okay, so they're not poor credit, right? They pay back because they have the intention to pay back, right? So in lending, you basically talk about the ability to pay and the intent to pay. And while the ability to pay is something which gets established by, let's say, credit bureau, but these customers are not on the bureau. So how do you establish their ability to pay? And their intention to pay also is about the history which is available in the bureau. And again, that history is not available with them. So how do you do that? So what technology, of course, does is that the context is not AI out here, right? There is a fundamental shift which is taking place in the operating models, and it is allowing companies and many financial services companies now to get those capabilities and then reach out to some of these things. So typically, what's when you look at the future of lending, what is it going to look like? Okay, people are going to live their lives. People don't think about taking a loan when they wake up in the morning. They live their lives. Okay, and in the process of living their lives, there is a requirement of finance which happens. So you're buying something, right? You're buying something online, and probably you have gone there to buy something, and you have certain budget in mind, but you then like something else, right? Because nowadays the recommendation engines are so powerful that suddenly something pops up and you want to buy that, but then you had the budget and you don't want to exceed that budget, right? So the whole payment system gets then integrated with the lending system, right, on a real-time basis. And then you are actually able to extend line of credit on a real-time on the fly to the customer. And so some of those things we will certainly will be seeing in the future. So like I said, right, it's very difficult to predict what it is, but then you can see some of the green shoots of these things which are taking place. Obviously, the whole proof of the pudding will take time. It normally takes time. For example, the blockchain technology itself, if you look at the Gartner's hype cycle, it's really at this point of time a hype. All the things that people talk about blockchain probably will happen 10, 20 years down the line, but it is as important and powerful a technology just like an AI, right? So we will see as it comes. I think we are living in the present. I think there are many challenges even today, but I'm happy to take more questions on this later on.
Yeah, Anindya, something that I had as a follow-up question, right, on what you mentioned, wherever there are large number of customers already captured, could be could be a Swiggy, could be a Starbucks, could be anyone, right, who has access to large number of customers and their behavior data, etc. We are seeing more and more, companies, our partners itself, like that we work together with, say, MI Credit and all, that companies that are not traditional lenders or that are not lenders in terms of, their primary business are entering this. And we know about, Aditya Birla being able to help a lot of them, right, as their partner. So do you see more and more of this happening as time goes and customer being completely okay with, buying from companies of whom primary business is not necessarily to do anything with financial services?
Yes. So very, very good question, Kedar. And this is a continuation of how the financial services would evolve in the future. And when I said that AI is just a technology, but the context is very different. And the context is that there is so some of the capabilities that were binding an organization, a financial services organization, are weakening. Okay. And this has necessitated a very, very deep ecosystem in kind of partnership to emerge. And the reason for that, and Xiaomi is a very good example, okay, which kind of manages and runs the Mi Credit app. And we are also integrated with them. We are, one of their extremely large partners. And not only Xiaomi, you think about anyone, any large technology company which basically owns the customer also owns the data. And today, you find a plethora of people who are on the lending side, or even on the banking side. The number of customers that they own is a fraction of the number of customers that the technology companies own today. So the traditional ways in which companies used to compete in the market, which could be on the price, which probably could be on speed. And when I say speed, again, speed was the improvement in the speed also happened using AI, by the way, right? So all your backend systems, all your operations, processes in the backend, this is probably the most base case or the basic use case of AI. How do you kind of automate processes? And most of the banks and large financial institutions have done that, and that actually ceases to be a competitive advantage. And so what do you do now? Okay, so you will have to actually go and create this ecosystem, and that becomes a force multiplier. Last year, I was in Shenzhen in China, and we met Ping An. For people who have heard about Ping An would know that it is the largest insurer in China. So what does Ping An do? Ping An has aggressively invested in building an ecosystem. Okay, so they are the hub. Okay, they're the hub in this ecosystem. So through a suite of apps in finance, in automobile, in healthcare, in housing, right? They have captured a massive scale of customers. Almost 880, 900 million customers are passing through their ecosystem at various points of time. There are about 17 million, small merchants and, medium to large merchants who are there. Massive number of, hundreds of partners who are there in their ecosystem. And they are able to now service this whole ecosystem and capture the value in the ecosystem with enormous speed, which we can't even think of. But, this is not something that everyone can do, right? It needs deep investments, to become a hub in a large ecosystem like this. So what should people therefore do? People have to actually go and tie up with companies and service providers who are front end and who are actually talking to the customer directly. Anyone can do that, but that needs a lot of money. But there are people who have, and the entire power is shifting there. If you look at the talent, for example, right? People at senior levels, people at entry levels, they're actually moving to service providers because that's where the customer is interacting. That's where the data is available. That's where you can create more and more innovative models. And, people who are able to actually do some of these ecosystem plays very well. And are able to negotiate, how the power equation kind of lies within this ecosystem. I think those will be some of the winners. I think the rest of the people kind of will keep falling back as time goes on.
An interesting example I have for this is recently a friend of mine was looking through all the insurance policies that are available because of COVID times and all. And finally, the best policy was found on a ride sharing application. And obviously it is in partnership with the insurance, but it is on a ride sharing application, right? So
absolutely. So ecosystems will emerge, I think, without any doubt. I think this is one prediction that I can make fairly confidently, that this will be definitely one of the force multipliers going forward. And you look at the banks, right? And my previous organization also realized that. And they, almost I think 5 years back, they created a new bank, okay, which was not only the innovation center, but it was looking at, which was looking at the future and trying to understand, where they should be investing, what solutions they should be investing on, and what kind of partners they should be actually partnering with, right? And many of the incumbent organizations, many of them have actually started doing the same thing. And that's really, what is required, right? So you will have to try and do things which defines the future, and you should be the one who probably is defining that future.
Absolutely. Kedar, Anindya, your point about, ride sharing company offering you an insurance policy and, Starbucks having an app where you can do transactions reminds me of this beautiful thought that I came across from a thought leader, where she said that the future of fintech is that fintech is not a thing anymore, right? The boundaries are going to become so diffused that fintech is going to become more of what some people say in India. Fintech is going to either become a feature, or fintech is going to be a very strong strategic pillar for a lot of companies. I won't be surprised if tomorrow Netflix comes up with a credit score for me based on the shows I watch, right? So
anything is possible. Anything is possible. And you look at the technology companies, right? I mean, there is so much of scrutiny on them today that they want to diversify. And where are they diversifying? They're diversifying into financial services. You look at Facebook, you look at Google, you look at Amazon. You look at our Indian, large fintechs like Paytm. Okay, where are they seeing the next revenue stream coming from? It's basically Paytm, of course, is in financial services. But the revenue streams are basically coming from lending.
Anindya, another interesting insight on this is a whole lot of these companies are not really making a unit economics profit also, right? And so maybe the consumer base is just a way to, the primary service is a way to get consumers, and finally it will be something like lending or insurance that actually pays for everything.
Well, that's interesting actually, Kedar, but I don't necessarily agree to that. Fintechs have made mistakes, and I think the whole idea of being a fintech is that you are trying to push the boundaries, and things are not known. There are no templates available on which you can build your business, and therefore you are bound to make some mistakes, right? But I don't think necessarily that when a fintech is starting a business, it does not have the unit economics in mind. It is probably that in the process of learning, they have made some mistake, and probably their road to profitability therefore is longer. Okay, and but I think a lot of the fintechs, if you look at on the lending side, have actually come around this whole thing, right? So the whole knowledge and the whole learning curve is almost over for them, and many of them, if you actually look at, have very, very good delinquencies, very, very good loss rates, in any case, the operating model that they run is extremely lean on costs, and it is all about getting a large number of customers, and that's basically what a fintech is very good at: getting a large number of customers and products which are far simpler, which could be short term, but it actually meets an immediate need for the customer. And once you have the customer and you have the enormous amount of data that you have, the next step, of course, that's really the story that the fintechs are running after, right? Then you can actually cross-sell multiple other financial products to them. So yes, from that perspective, Kedar, you're right. I think the road to profitability is longer for these guys, but I think most of them, because this is a story that actually started 4 or 5 years back, probably in 2015 or so. I think most of the guys who have survived the last 4 to 5 years are actually in a very, very strong position.
Right. So Anindya, this naturally begs the follow-up question. What does this mean for traditional lenders? And this also brings us to the next question. It segues into the next question that you being from a physical plus digital lending space, from that vantage point, what are the changes you are seeing right now in the present? So we just discussed about the future, but would also love your thoughts about the immediate present and the next and the near future.
Sure. See, look, when you talk about the immediate present, of course, we are talking about the uncertain times that we are living in, right? So the pandemic really has clobbered the economy, it has clobbered the financial system. We are living in a time that we could not even imagine a few months back, right? So obviously that has an enormous bearing on the immediate present, and basically, if you talk about the pre-COVID times, you would see that over the last 4 to 5 years, most of the banks, most of the NBFCs were actually focusing on retail lending as a way to profitability. And the reasons were very simple, right? The corporate lending was going through a problem. There were cyclical, problems which were coming through the corporate lending. There were a huge amount of NPAs which were actually piling up, and retail lending. The context of retail lending, of course, is that the economy has been pushing, right? So consumers have been going out and buying. They were feeling good about the future, and therefore they're spending more. And therefore the retail lending was actually growing at I think about a 15% average annual over the last 5-6 years. And suddenly, something like this takes place, and the fresh dispersals come to a grinding halt. Okay, everything stops almost overnight, and then the whole uncertainty, because you don't know how to come out of this uncertainty, what you should be doing. The data typically which is used for underwriting and for lending, that data does not make sense anymore, because you don't know whether lending traditional. We talked about traditional lending, right? Traditionally, people have been looking at a point of time in terms of data. Looking at this point of time when the customer is actually taking a loan or a credit card, any financial product related to lending, you are looking at the bureau data, which is historical. And at this point of time, what's the score? You are looking at a bank statement, which is of the past 3 or 6 months, and those kind of financial data, ITR, etc., which is the last ITR, and you're taking a call. Now, all of those things will look good, because let's say talk about April and May. If you wanted to give a loan to a customer and you're looking at the past bureau data, the past banking, the past ITR, all of that will look good. But can you give money to the customer? So a huge amount of uncertainty, and obviously everything came to a halt. On the other hand, collections, which is one of the pillars of any lending organization or a business, one of the two pillars really, right? One is the underwriting, and one is collections. And if you have bad underwriting and bad collections, then that's like a recipe for the doomsday. But any of these pillars also, if they're weak, obviously that is another recipe for your doomsday. And collections, specifically went through and is going through a lot of stress, because people, obviously, when you look at the data on the consumer side, a large number of people's earnings have reduced. Why? Because the gig economy got hit very badly. Many sectors which were informal were covered. Aviation, entertainment, parts of retail, which was discretionary in nature. Everything basically got badly impacted, and that led to people losing jobs, people getting cuts in their salary, people small businesses kind of having no source of income. So these are the underlying reasons why things are so uncertain, and growth is going to be such a big challenge as far as this financial year is concerned. Because till the time these things do not improve, okay, it will be premature to say that lending will pick up. And a lot of people talk about normalcy coming back in October, November, third quarter, fourth quarter. Right, some of the normalcy of the pre-COVID times will not come back. Yeah, till the time some of these things improve. Yesterday, I kind of got an update, a screenshot of a news channel, which said that the regulator is thinking of extending the moratorium till December. Okay, and we don't know whether that's true, whether that's not true. You can't believe the news channels that much more nowadays. But I mean, if those are some of the things which are happening, then obviously things are not getting back to normal, very quickly. But yes, the economy is slowly opening up. I think the unlocking, has happened, but it'll take time to come back to normalcy. Obviously, the government is, has and the regulator together are kind of helping with several schemes, so that at least the small merchants, the micro merchants, are coming back, and they're able to actually get back to normal. Everyone needs, these are the guys who have the need for credit if they have to come back to normal. But the whole approach has become very cautious as far as lending organizations and banks, are concerned. And a lot of customer education is also needed, right? So people may have money at this point of time, but they probably are not paying, right? The whole effects of moratorium. I think, people, and, we have been doing this constantly with our customers, because people do not completely understand what this moratorium is and how financially probably for people who can actually pay their installments, how financially is not the right thing for them to actually do. Because eventually, no one is actually going to be waiving off the interest for this particular period. So you may get a EMI holiday for a long period of time, but then the interest is all accruing and eventually you will have to pay. So it is, and for home loans, some of these numbers are fairly large in terms of the liability that the customer will have. So, the present is, I would say, while, there are some green shoots and the economy probably slowly opening up, and we see that in our experience in our portfolio as well, but those are very slow and those are very gradual, right? And that will obviously take some time to come back. So yeah, so that's how I kind of think things will happen.
Anindya, thank you so much for sharing that perspective. And I'm sure the audience would definitely love to understand from your vantage point, based on what you've seen and what you know. If you were to start a lending organization today, and assuming the coronavirus slowdown recovers significantly, right? Assuming that scenario, if you were to, and you told us that you're building a lending org already. So what does the lending org of the future or of today look like? What does the product look like? What does the stack look like? What does the team composition look like?
So lending fundamentally is the same. Okay, so you have to do a proper assessment of the customer, and you will have to then be able to collect, when things go wrong. I think these are the two fundamental aspects of any lending business. What basically has happened is that the customer's expectations and the customer's behaviors have changed, from probably when in the old NBFC, where I actually cut my teeth when I started working. From those days, those years to what we have today, that's basically where things have changed. Customers' behavior has changed because of the large technology companies changing behaviors in the online world. That has obviously meant that there is an enormous amount of data which is available. In fact, you would have read some of these your surveys and data which says that an average Indian spends about 6.5 GB. Consumes 6.5 GB of data every month, compared to a 2.3 GB in China. Okay, and probably India is the largest consumer of data, or user of data, and that basically means that there is an enormous amount of data every Indian is generating. So that was not there before. Okay. The regulation is getting more and more friendly. Okay, so if you look at some of the things which the regulator and along with the government has done in this country as well, is not probably there in most of the countries, right? So this whole India stack, as we know it, right, which is a presence-less, cashless, consent-based layer. It's such a big enabler of some of the new operating models which are coming up. So all of that kind of talks about one thing, right? All these things have to be there part of the lending business when you have to start that business today. I spoke about how artificial intelligence, generally speaking, so there is a spectrum, right? So AI starts with how you can do things better, which you're doing today, to smarter decision making and probably products, which have completely new value propositions. So how you do good, how you improve your processes today, that's something which AI is certainly helping out today, and that's something which is very important. So when you think about a lending organization today compared to what you had in the past, technology will anyway play a very important role. Now, it may not be an end-to-end digital process, because every lending product that you sell is not digital in nature. So it's a phygital process, right? Even the pure digital processes that you will find that there will be a small segment in that of customers in that as well, where you will probably take a pause. Okay, so you cannot have a car without brakes. If you try to actually go, and this is exactly what some of the fintechs did in the past, where they thought that you have the data and you can just go without actually pausing and taking a break. That's not what works in lending. Okay, so you will have to know when to put the brakes. So you need to have brakes in your car. And what basically data helps you to do is to define and identify where exactly you want to put that brake and where you want to actually go seamlessly into a manual process, and then do probably some checks. And when I talk about manual process, it's not about really making someone visit that customer. So today you have technology which is video based, with the underlying technology again being AI, where you can actually, and a lot of that I was able to see in China, and a lot of that is actually starting in India, where the videos are read by bots. Okay, you don't really have a human who's reading the videos, but what a video does is that it establishes the contact with the customer. And we talk about a lot of these fraud prevention and AML and all of that, right? These are some of the things which not only helps to know your customer, but also are very, very good mechanisms to prevent, fraud. So when you go through a online to offline process, it has to be seamless. The experience, of course, is in these days and going forward, the experience is something which you will have to actually think of it all the time, because every time you actually put something in place, you are compromising on experience. Yeah, and that's the reason I was saying, right? The people who own the customer, the service providers, okay, they own the experience. Okay, and when you talk to them, they will always say that experience comes first. When you talk to Amazon, they will always talk about experience. And every time you ask for more data, you are actually, or every time you want to do more things with the data, you are actually somewhere compromising on the experience. So that's the fine balance, which has to be thought about, when you're building. Earlier, it was not the case. Okay. Earlier, there was no segmentation. There were every borrower had the, kind of same experience. All right. And that went all the way up to collections. Okay. Collections, like I said, is a very important pillar. But earlier, what used to happen is that, I remember, right, because, during the bad times, during the crisis, I did collections as well. And, we had some 14 or 15,000 collectors on the field. Of course, it is not surprising because we were the largest consumer finance company at that point of time. Everyone used to carry a piece of paper, which was called a stat card. And you had, all the information about the customer, the delinquency strings, and how he has paid, etc. And every customer was same, right? It was just this piece of paper which was information, but in the minds of the collector, every customer is the same, and you deal with them exactly the same. But today, if you have to do collections, you wouldn't really you have to identify the medium, firstly, with which you will interact with the customer. You have to identify the right tone, when you're interacting with the customer, because delinquency does not mean the customer's bad. Sometimes the customers are lazy and they just need a nudge and remind them that, your payment is due, and it happens with all of us all the time. Sometimes, especially during these times, people may actually be going through a temporary financial difficulty, but it's not that they don't have any intention to pay. And that's why, this moratorium helps those customers. Okay, but so all the customers cannot be seen from the same lens, can be colored with the same broad brush. Okay, so those kind of segmentations today of the borrower's risk is possible. Today, you can predict customer will go delinquent even before he goes delinquent because you have the data. Okay, and basis that, you are able to actually segment your customers and identify what is the kind of treatment that you want to do, and how do you want to deliver the tailored communication through the identified medium with the right tone, with these customers. There are a lot of customers who self-cure just because you do that, right? And the experience does not kind of get affected because of that. So I think some of these things which were not there in the past, if you are thinking of a lending organization today, I think underwriting and collections are the two main pillars. On these two pillars, you can have thousands of operating models. Okay, and that's basically where your innovation by the fintechs comes into place, where the disruptions are happening. There are players in the market such as yours, okay, who basically are helping in this whole disruption and the new operating models. And there are people in all kinds of different, so the whole end-to-end process is disintermediated today. So if you look at the underwriting piece, that's disintermediated because you have alternative data, and you have players who actually provide that alternative data. You have data available from utility companies, from e-commerce, from cab aggregators, and then you have these bank statement companies who are actually extracting information and doing a lot of things on these bank statements, which again goes into helping underwriting. Then you have the industry players who are helping you in KYC, in signing your agreements or mandates online, so all of that. So none of these things, and that's the point I was making a little while back, right? You cannot do all these things by yourself if you want to start a lending organization today. You will have to get into partnerships. You will have to find the right partner given your operating model and what exactly you're trying to do. How you're going to underwrite, how you're going to actually do fraud detection. And all of that depends upon how you actually build an ecosystem around your business model. And then kind of, make the lending business, right? But having said all this, right, you can build many operating models. There will be 1,000 different operating models, but the core pillars remain underwriting and collections.
Understood. Thank you, Anindya. Quick time check. We are at 11:45, and at this point, we usually open up for audience to ask their questions. So I encourage our audience members to share their questions, which we will take up one by one. When you're sharing your questions, also please let us know which organization you're from, and we'll be happy to acknowledge that. One of the first few questions we have is, so the one question from Sunita Manwani, who is the Chief Strategy Officer at Nearby Finance. Welcome, Sunita. Sunita's question is, so we have a lot of data points for urban customers because of their consumption patterns and the data they generate, like you said, Anindya. But what about rural customers? Because there is a question about what amount of data is available, and hence, how do you use those data points to generate credit worthiness or fraud tendency?
Yeah, so that's the challenge, right? I think the benefits of technology have not really trickled down probably to the rural customers. But having said that, I think the whole revolution on data and on mobility has reached there, obviously, and it's just a question of time when the right kind of data is getting generated out there. I think the rural customers today are being serviced more by the microfinance companies, which works in a very, very different model. It's not a one-to-one. It's not that individual customers are given. So you kind of have these groups, which is managed by someone, and then that's how you kind of lend. And microfinance organizations are actually going and lending out there. Data is getting generated, right? So there are people who are in between who actually facilitate that funding, from the investors to the final people or the MFIs who actually need that fund, right? And they are doing a great job out there as well. And there's a lot of data that they also possess at this point of time. Not only the MFIs, but people who are actually facilitating the money which is coming from the investors, which could be a bank, and a lot of banks and a lot of large investors have started, a lot of HNIs have started taking interest in the whole rural and the MFI business because it has been such a successful business model in the country, right? Despite, I talked about those calamities that they have gone through. It's not that, these MFIs have lost money. It has taken time for them to get back, but they have actually got back the money from these people. So I think, yeah, data is going to be a challenge for some time. And that's where, technology actually plays a role, because it is impossible for a large incumbent bank or an NBFC to reach out to that last mile. Okay, it is just impossible. And because there are cost structures, there are considerations on what kind of risks you can take, and there are business models and operating models which you cannot change overnight. So these are really new opportunities which are there, which will be enabled by technology, data, and AI. But where people other than, and probably I don't know whether it is the lady who asked the question, her organization, probably who they are looking at reaching out, and they are looking at how data etc. can be generated and then monetized. But yes, I think it's a revolution which will probably happen in due course of time. I can see the screen which has frozen for Deepak. I don't know whether you guys can still hear me. Kedar, can you hear me?
We can hear you, Anindya.
Okay.
Anindya,
okay.
We can hear you.
Okay.
Yeah. Anindya, quick follow-up on question on that. You mentioned about two pillars. So one is the underwriting and other is collection. So, in the rural context, in a digital manner, how do you see collections panning out, right? Because the MFI model of a group is also a model that helps collect efficiently.
That's right. That's right. Look, I think, so one of the things which has happened from digitization of collections, earlier I talked about a stat card, right? A physical paper which used to be there. Today, I think pretty much everyone that I know of has automated that part. Okay. So when you're actually going to a customer to collect money, that need not be a delinquent customer, right? Because in an MFI situation, you have to collect probably money, and that's a very, very cash intensive economy even today. But the information which is available to the person who is going out and collecting is all available digitally. So today you do not really have to do some of those things, and that's really the efficiency which has come in. And when you collect that money, that information is also on a real-time basis reflected in the backend core system. Okay, so you know that this money has come back. So I think some of those things definitely are there, but that's a very cash-intensive economy. I don't see over the next 5, 10 years, that going away. In fact, even the metros are very cash-intensive. I remember, when the COVID started, right? People actually, including myself, actually went and actually withdrew a lot of cash because even today, we pay a lot of people in cash, and people said that cash will just run out because banks are closing and the ATMs are going to run out of cash. So I also went and withdrew cash, but interestingly, the cash is still lying, most of it. It's very, and that's a learning. That's a learning because you think that you will need that cash, but actually most of the people were not coming to your houses, right? And they needed the money, and you transferred the money to them online because everyone said do a Google Pay. Okay, and I didn't know before that, because before that I was paying cash to them and they were happy to take cash, but then things happen on Google Pay and the cash is still lying. So who knows, that future may be very near when even the rural guys probably understand. And the pandemic, you don't want to actually touch cash anymore, right? Because that could be a carrier of the virus. Okay, so who knows, maybe some of these things are happening in the rural economy as well today as we speak.
Thanks, Anindya. Next question is from Abhishek Kannan from Lendane Club. Welcome, Abhishek. Abhishek asks, is there a possibility that part of the collection process can be driven by AI? And what is your take on this, Anindya?
So as we speak, collections is being driven by AI. Okay, we do collections, a lot of our collections using AI. And again, I was talking about how do you segment the borrower's risk and how do you predict the borrower's default. Okay, and that is a very evolved science as we speak. And when you do that, you really don't want to put a lot of cost in your collections activity, because not only it's the cost, it's also the experience that I spoke about. You do not want that experience to be compromised because the customer is not an intentional defaulter. Okay, so there is a segment of customers which intentionally will not pay you, but then there are customers where you would use automated methods. So we use AI bots. Okay, where and what are these AI bots, right? So these are bots which actually reach out to the customer using chats. Okay, or they could be dialing those customers using an IVR by passing on a message to the customer which is automated and pre-recorded. Okay, just to remind, large segment of customers probably where the outstanding is on the lower side, or where the risk is on the lower side, right? You would typically use some of these methods. So yes, as we speak, we are using some of these methods today.
Understood. Next question from Ravi Sethia is, how do you look at the impact of the Aadhaar account aggregator ecosystem, right? What have you seen based on the adoption so far?
So look, the account aggregator ecosystem obviously went through a bit of a challenge because some regulatory norms getting changed. The way this is happening in some of the other markets like Europe, UK, Singapore, this whole revolution about open APIs, where the regulator itself has actually pushed these banks to open up their APIs. I think that's probably, to me, is the right way of doing it. And if that also happens in the country, where banks are by regulation asked to open up their APIs, and then there are people who will then consume the APIs and then do the account aggregation using open APIs, that's a much better, much more robust, from a technology perspective, method of doing account aggregation. Today, our account aggregation, the way things stand in the country, is using the customer's consent, but then not having the whole data being opened up on the banking side or the financial services side. And there are changes which are taking place there. I think those changes are fairly slow at this point of time, but I don't think that it will take a long time once the realization, and I think the realization is there. Probably it's a question of at some level in the government or the regulation, that kind of getting taken up to make sure that that whole ecosystem is getting built. But account aggregation, without a doubt, will be the way forward. And some of the things that I spoke about in terms of how deposits and lending is going to look into the future, it is always going to be the service provider at the front end who will then jump in when the account aggregation is available, to be able to give the experience to the customer, because he owns the customer and he owns all the data. So I think it's just a matter of time when some of these models will emerge, but it will have to be aided and supported by a lot of regulation and industry platforms, for that to happen.
Interesting. We have Kalyan from Perfios. Welcome, Kalyan. Very interesting question from Kalyan, Anindya, and I think you're the right person to answer this. Moratorium availed, right? If a customer avails a moratorium, would that affect their underwriting parameters for future loans?
Yeah, the short answer is that it has already been clarified by RBI that the score will not get affected.
The score will not get affected. Right?
Yeah, that's right. Because moratorium basically means that you have temporarily paused the DPDs to move forward, right? Days past due. Sorry to use the technical jargon like that, but so that kind of and so your score will not get affected. But however, you don't know at this point of time that the customer is in a genuine financial difficulty, or the customer probably is taking a moratorium because this whole fear factor is there on the mind, right? And you're preserving cash. That we don't know, right? And that only time will tell.
Understood. Interesting question from Shelly Arora. What do you think about post-moratorium scenario for collections, where there is a huge load on economic load on customers, especially maybe MFI customers? You've answered part of this, but what are some things to keep in mind when collecting from such customers in the near future?
I think we have to be very sensitive to this fact, right? And like I said, the MFI example shows us that when there is a temporary financial difficulty because of anything in the environment, obviously there is a spike. But if you look at those, curves, and many of those curves are now publicly widely available on the MFI sector, you will find that eventually those have normalized and they've come back to the old kind of limits, and the customers have paid back, because they take the money for their local economy. Okay, they might need it for, let's say, fishing, they might need it for farming and things like that, and that gets affected in the temporary period. But they pay back because they need the money again, and they know that if they don't pay back, they will not get the money again. And because they need this money, right, so they take maybe 50,000, and next time they take a lakh, next time, so it always keeps going up. So they always, so so MFI is the reason, this is a great story, is because they've done such a great job in fact creating that awareness and education in that segment as well, where people know that they have to pay back eventually. And I think in this time as well, I believe, and when you look at the data on an aggregate basis, you actually see that people's earnings have dropped. Okay, when you look at the banking, you see that the number of credits which is happening in that has actually come down. Okay, and if that is a proxy for earning, then you know that the earning has come down, and that will come back again. Okay, and once that comes back, I'm sure customers do not want their credit history to get spoiled. But like I said, right, there is a bit of an awareness, which a lot of it, which actually needs to be done to tell the customer that after moratorium, it's important for them to actually start making the payments. And then, there are financial tools available, right, where you actually extend the loan and, give them further kind of breathing time for them actually to pay back, right? So those kind of restructurings are also available, but they kind of, also kind of take a beating on the credit score. But yeah, I think, like I said, right, collections of the past, which used to kind of treat all customers as the same, and there was always this whole balance between efficiency and customer experience. But some of those models are actually not there anymore, right? I think people use collections and look at the telcos. Okay, Vodafone actually said this whole thing in the past. Vodafone collections, you don't even feel, look at American Express, for example. I always think, because I have the card, right? I always think, such a fabulous job they do when they actually ask you, tell you that, you kind of, missed your payment. Okay, and it has happened to me before. I needed that nudge, and when you get that call, the whole call is so, it is a pleasure actually, to speak with the agents in the call center. So I think some of those things are available in most of the places today, and the sensitivity of the situation that the customer may be going through financial difficulty, that has to be taken into account without a doubt.
Thanks, Anindya.
For time check.
Yes, I was just going to say quick time check. I didn't realize when time just flew by. We are at 12:01. I don't think we'll be able to take any more questions for now. But Anindya, if you have any other thoughts that emerge in your mind that you want to share with the audience, I think the right time to do so right now. Welcome any additional thoughts that you have.
I think just a parting thought, right? I think this pandemic actually has changed the behaviors of customers, right? And a couple of months back, we were all in the anxious territory, but today we basically are in the territory of stay calm but carry on, because all of us now know that we are going to be living with the virus for a long period of time. I think a lot of the customer sentiments. So consumer lending typically is a customer sentiment thing. When the sentiment starts changing and people start believing that the future is going to be good, I think a lot of these people will come back to the bank. But what's very important for companies is that what it has done is that it has put most of the companies on steroids as far as their online channels are concerned. Obviously, everyone was doing that, but I think what people were planning to do over a few years, I think now they're looking at doing over a few months. And I think that's really the exponential jump in the virtual interactions which is now taking place. That is going to put a lot of pressure on companies, and people, companies will have to actually take that challenge and come up, right. The traditional customer touch points will eventually see a decline, I think, even after the COVID situation, because some of these behaviors are going to continue. The traditional channels will be there, the touch points will be there, but I think it's very important for the companies to realize that like all other industries, even this industry will go through a huge technology revolution. That's basically what I wanted to leave as a parting thought.
Thank you so much, Anindya. Kedar, do you have any parting thoughts based on what we just heard so far?
Yeah, I think Deepak, we are all looking at numbers constantly, right? Like how the behavior is changing for customers. So we are seeing a recovery, but it's definitely not looking like a recovery that is as fast as the momentum with which it dropped, right? So I think it more looks like the recovery is going to be a pretty slow process, and right now there is no way to predict future. So I think everyone is looking at what to do in the next 30 days, right? And how to change behavior in the next 30 days. I think all the 6-month plans, 12-month plans are all out, and everyone is like, next 30 days, how do we, what are the decisions that we make?
Absolutely.
Totally agree with that.
On that note, Anindya, thank you so much for spending time with us here. We really enjoyed the insights that you shared. We're looking forward to having you on this forum again in the future, maybe as a panelist, maybe as a participant, and continuing this information exchange. Want to thank all our audience members also for being here. Thank you so much for listening. Thank you so much for asking these questions. We will be compiling all the insights from this session and we'll be putting it up on our HyperVerge blog. On that blog, you can also go through the previous sessions that we've had. A lot of interesting insights by a lot of interesting people. And on that note, looking forward to having you all here again next time for HyperInsights, which is a dose of signal in a world full of noise in the fintech world. On that note, we can conclude this meeting today. Thank you all.